great to be back with you on Armourgate Radio Communications, and our theme is corporate financial strategy and sustainable growth. Corporate financial strategy and sustainable growth. I'm your anchor, Abiodun Abari. Welcome, everyone. Yes, we continue in our quest to break it all down for you when it comes to achieving sustainable business growth, responsible sustainable business growth through the path of an efficient corporate financial strategy. Okay, and very important to understand the role and an efficient corporate financial strategy plays in achieving the prize of sustainable business growth. For instance, we talk about how much of an insight there's a metric like energy return on investment give in terms of sustainable growth. How much does the adoption of green strategies impact sustainable growth? Okay, we talked about studies that have shown that environmental factors are more impactful for sustainable growth than corporate governance. Okay, so we'll talk about the improvement of the organization's position, value addition for shareholders, attainment of stakeholders' objectives. Okay, so all about the frameworks that underpin the synergy, they underpin the adoption of sustainable financial practices. Okay, and the quest for balanced, responsible, sustainable growth. Okay, so continue to look at strategies that have been adopted, successfully implemented by organizations to attain sustainable growth. And basically, we must understand that growth itself is intentional, it's planned. It might not be something that it's accidental or something that happens by chance, okay? Something deliberate, something pre-planned. And a robust, adequate corporate financial strategy is at the very heart of this purposeful channeling, to achieve a responsible, sustainable business growth. Okay, so the sufficient corporate financial strategy must inculcate every consideration cohesively so that clear, unambiguous, measurable, and realizable goals can be efficiently attained. Very, very important that every consideration must be cohesively inculcated. It must be balanced. All right. So, and you find that the percentage of organizations that actually experience high growth has continued to decline considerably, has continued to fall. All right, so data from the United States Census Bureau show that the decline from showed the decline from 20% in 1978 to less than 13% in 2020. All right, so growth or high growth, sustainable growth is not a given. It's something that organizations have to work assiduously for, and something that a lot of organizations are actually failing in achieving. All right, so and remarkably, CFOs must continue to deliberately devise strategies to ensure that revenues and profits are sufficiently grown. Okay, optimal investments are made, and adequate liquidity available to meet obligations as and when due. Very, very important for CFOs as the leaders when it comes to strategic financial management. They must continue to deliberately devise strategies to ensure that revenues and profits are sufficiently grown. Okay, and optimal investments are made, and of course adequate liquidity to meet obligations as when due, conditions that will engender sustainable business growth. And the corporate financial strategy must be effective in aligning the capital structure of the organization, the revenue and profit projections, and the risk framework with the overall long-term goals of the organization. We've said this in multiple dimensions to try to emphasize this. Very, very important. That the corporate financial strategy must not be in isolation. Must always ensure that the capital structure of the organization, the revenue and profit projections, and of course the risk framework are all aligned with the overall long-term goals of the organization. And we also continue to talk about the capital mix, that mix of debt and equity, okay, utilization of green funding, green bonds, and ensuring sustainable and responsible business practices, sustainable financial practices, okay, very, very important, arriving at that optimal mix, optimal capital mix of debt and equity, getting the optimal cost of capital efficiency, okay, also exploring green funding. All right. So, cost management practices too must, which you have explained, very, very, very important. They must be optimized. Cost efficiencies must be optimized. Those very, very important to create the right environment for sustainable growth. Okay, and we continue to talk about the optimization of cash flow. Okay, cash flow management should be optimized, and that should be done in a proactive manner. Okay, projections should be made objectively and in a data dictated fashion. All right, projections should be objective, and it should be dictated, market dictated. All right, so realistic projections so that decisions can be made. All right, and talking about the optimization of cash flow management. All right, and you always want to remember that the corporate financial strategy is an adaptable document, is a flexible document, always ready for tinkering, the right tinkering that will reflect data dynamics. Okay, and the mindset of giving the organization an edge in the face of competition. All right, the essence of the tinkering is not just tinkering for tinkering's sake, but to be able to give the organization an edge, to achieve the sustainable growth objectives of the organization in the face of competition. Okay, so very, very important that we always remember that the corporate financial strategies adaptable documents, a flexible document, always ready for tinkering based on the feedback. Okay, might be feedback from financial performance management, all right, from evaluation of financial performance, all right, from the weekly variance evaluation, all right. So feedback that ensure that actually a call for tinkering to ensure that the corporate financial strategy will continuously, consistently deliver on the objectives, overall objectives of the organization. Okay, so of course we talk about the essence of continually achieving the going concern objectives of the organization. That cannot be overflowed. That you want to ensure that the organization continues to exist in perpetuity. All right, and the role of the corporate financial strategy in ensuring this has been well explained in the previous episodes of this quarter. All right, so of course, this cannot be taken for granted. Cannot be taken for granted that an organization will continue to exist in perpetuity without intentionally working to ensure sustainable business growth for the organization and ensuring that you draft a corporate financial strategy that will ensure this lofty objective of ensuring the business concern of the organization. And my interest is to know that less than 40% of businesses exists after a decade. After a decade of establishment, about less than 40% of businesses still exist. So it cannot be taken for granted that we always have the growing concern objectives being achieved. All right, so they must be intentional. There's intentional sustainable growth. There must be intentional corporate financial strategy that will drive sustainable business growth. Okay, so and you reckon that this might be attributable to various factors. All right, but having a potent adaptable corporate financial strategy will be handy. Okay, and a study by Liberty University showed that organizations with post-formation plans, organizations that had post-formation plans as at formation, as at inception, they have a 12% higher likelihood to sustain their going concern objectives than those without a post-formation plan at inception. All right, so the essence of having a strategy, okay, very, very important to have been proactive. That's actually impacts the going concern, the credentials of the organization. Okay, so the overall vision of the organization must be well understood and clearly communicated. All right, so that this can be translated steps. Okay, as translated to steps that ensure that the lacuna between strategy and growth, actual outcome of growth, is bridged. All right, so very, very important. So that we ensure that we can get there when it comes to outcome, when it comes to growth, that strategy takes us right there. So to get that, the overall vision of the organization must be well understood and clearly communicated. All right, so you talk about engaging in the activities that will ultimately push the organization towards the attainment of its sustainable growth objectives. All right, for instance, the engagement in robust revenue forecasting or robust revenue projection will aid the early identification of funding gaps so that timely capital raises can be done. All right, so when if revenue forecasting is well done, when the revenue projection is effectively done, all right, so future gaps can be early identified. Funding gaps can be identified early, all right, and plans can then be put into place to ensure that the capital raises to bridge the funding gaps are timely. Very, very important. And also, we talk about quarterly updates of rolling budgets. Okay, when you engage in quarterly update of rolling budget, it will help keep resource allocation and dynamic sales pipelines in sync. Very, very, very important. All right, help keep resource allocation and the dynamic sales pipelines in sync. Okay, as long as you have a quarterly update of rolling budget, so the feedbacks will help in the trying to ensure that the resource allocation and the dynamic sales pipelines are kept in sync. Okay, and when the KPI displays or the KPI dashboards are influenced by strategic goals, okay, by the strategic objectives of the organization. So the visions are easily and quickly identified, and with the right thinking is enabled to ensure or to engender goals attainment. All right, so the KPIs displayed should be such a manner so that they can be reviewed, can easily review deviations, easily review variances at a glance. All right, saving time and ensuring quick response to ensure that outcomes, future outcomes and plans are the same. Okay, so and you talk about the scenario analysis and stress tests. Okay, so analysis of scenarios and stress tests to help the organization prepare for market shocks, market alterations, market vicissitudes, as growth projections are protected by estimating the risks involved. Okay, so with the scenario analysis and the stress test conducted, okay, the organization will be prepared, because the risk involved will be well estimated, and the organization will be able to prepare for market shocks when they appear, when they happen. Okay, so it's about being proactive, and it's about saving for the rainy day. Okay, being able to navigate the economic headwinds when they arrive. All right, so the scenario analysis and stress test will help the organization prepare for this scenario. And of course, we're talking about having rolling 12 to 18 month budgets. Now, built to adapt to shifts in the market. Like I said, what you have as a document, what you have in your corporate financial strategy must be flexible, must be adaptable to market dictates, to market shifts, market alterations, all right, to market dynamics. All right, so you have a rolling 12 to 18 month budgets built to adapt to the shifts in the market. And of course, revenue targets and cost baselines are aligned with long-term financial planning models. Revenue targets and cost baselines are aligned with long-term financial planning models. And the employment of zero-based budgeting, okay, very, very important, so that spending is rejustified, okay, so that every expense item is rejustified and reapproved quarterly, okay. So with zero-based budgeting, you ensure that quarterly every expenditure here is rejustified and reapproved, so that's to continue to improve our cost efficiency. All right, so this actually streamlines activities. Activities focus. This streamline actually achieves focus. Helps the organization focus on activities that will engender sustainable business growth and free up funds for innovation. All right, so when some expenses are no longer justified, there will be more funds, there will be available funds to fund innovation that will give a competitive edge to organization and drive revenues, profits, and growth. Okay, so the importance too of optimized cash flow management cannot be oversized, like I said. So because a situation of lack of liquidity stores growth. Okay, so credit terms should be balanced with discounts from suppliers. Very important. Credit terms should be balanced with discounts from suppliers, and of course, rescheduling should be engaged in. And you look at that data from Penn State Extension show that 82% of business failures is from poor cash flow management. 82% of business failures is from poor cash flow management. So cash flow management, very, very important, very, very key in designing that corporate financial strategy document. You have to ensure that cash flow management is actually optimized, all right, ensure that there is liquidity to fund the activities of the organization, and that can be done by ensuring that credit terms are balanced with discounts from suppliers, and also engaging the data rescheduling. All right, and we also look at the contingency planning. To ensure that the risk management is robust and adequate, sufficient. All right. So shocks and surprises can be mitigated and readily dealt with if, for instance, credit lines are pre-approved for downturn times. All right, or operational and financial and strategic risks are mapped against probability impact grids. And of course, if you have decision trees that can enable cost freezes on capital or capital redeployments, okay, so that to be activated when metrics raise an alarm, when metrics flash red, when metrics are down. All right, so you have decision trees that can actually enable cost freezes or capital redeployments. Okay, can enable that activation. All right, so we talk about the measures to ensure that shocks and surprises are mitigated and readily dealt with. Okay, when they arrive, when they happen. So talking about the contingency planning to ensure that the risk management framework is robust and efficient. And when allocating capital, all right, the hurdle rate screening and the NPV, net present value ranking of the projects, very, very, very important. You ensure portfolio balance. All right, very, very instructive to ensure portfolio balance when allocating capital. Okay, so you use the order rate screening, and of course you have the NPV, net present value ranking of the project, and of course the weighted average cost of capital, the WACC, should be optimized by blending retained earnings with selective debt, cherry pick debt. Okay.
Armourgate, founded in 2008 out of a desire to build transgenerational structures for organizations, institutions, and nations. We have worked with large businesses, international development organizations, and public sector ministries and agencies. Armourgate, our uniqueness is that we do not just work for you, we work with you. For example, we do not leave you to the task after sourcing talent that will help the new hire settle into robust leadership development programs. We are technical experts in advising and supporting institutions on strategy and leadership, artificial intelligence, strategic human resource management, public sector reform, finance, audit and tax, FAT, and strategic communications. We do all this and more out of a desire to transform nations through institutions and organizations. For further inquiries, email contact@thearmourgate.org or call +234 810 999 6666, +234 807 957 4151, and +161 0504 6026. www.thearmourgate.org. Armourgate, building to endure and transforming nations through institutions and organizations.
Blending retained earnings with selective debt. The weighted average cost of capital, the WACC, should be optimized by blending retained earnings with selective debt. And a flexible approach to capital allocation is necessary for a positive or a forward-looking corporate financial strategy, right? So for the corporate financial strategy to be relevant going forward, for it to be positive in outlook, it must be flexible, all right? So that capital projects are reevaluated quarterly, all right? And funds are redeployed from underperforming funds, from underperforming projects to new or other performing projects to other projects, all right, to optimize the use of funds. So you understand that capital projects are reevaluated quarterly to redeploy underperforming funds. I'm talking about tracking or review evaluation of financial performance. Weekly variance reviews. We ensure that a stitching time saves 9. Okay, so you want to ensure that you stop the bleeding before it becomes a hemorrhage. All right, you want to ensure that real-time KPI dashboards, cash conversion cycles, and the accuracy of forecasts, and all that. Bridging that gap between strategy and outcomes is very important, so that the feedback can come easily, quickly, at a glance, and the tinkering can be done in quick time, and the organization can be competitive in addressing these challenges, in addressing the tinkering necessary for the corporate financial strategy. Now we look at how the financial strategy itself, how it drives business growth, how it drives corporate business growth. So we look at the optimization of the allocation of resources. So talking of strategic allocation, the movement of capital from low return projects, from low return tax to high return tax, okay, to high return endeavors. You understand? So capital allocation, resource allocation must be optimized, all right? So allocation of resources from low return to high return, all right? So of course you map each cost line to the potentials in terms of revenue. Okay, so the projects are ranked, against their hurdle rates and thresholds, so that we ensure that the funds flow to the optimal financial strategies for growth, to ensure that the business growth is sustainable. All right, so it's not about keeping legacy. It's not about keeping with tradition. It's about reevaluating and ensuring that each allocation is justified. Okay, so we're talking about a well-tailored loop, a well-tailored connection between the forecast, the spending, and the review. Okay, so that the broader financial strategy, the overall financial strategy for sustained business growth, okay, is well detected by alterations in the market, or shifts in the market, and you have funds are freed up for innovation. Okay, so of course the management of the cash flow to ensure stability, the stability even when growth and expansion is taking place, because growth and expansion have a tendency of causing instability if not well managed. All right, so very, very important that during that time the liquidity framework must be robust enough so that growth must not outpace cash. Growth must not outpace liquidity. There must be adequate liquidity to fund growth. So this can be done by maybe building 13-week rolling forecasts, that actually make sales updates, okay, daily sales updates, and of course the accounts payable data, making sure that it's available daily, like for a 13-week rolling forecast. And we can also ensure that the receivable cycles is shortened, all right, by trying to incentivize early repayment, incentivize debtors, okay, with early repayment, like giving them incentives to enjoy that early repayment, and that will give a shortening of the receivables cycles, and also boost the liquidity of the organization. Okay, and of course can also layer in a revolving credit facility, maybe estimated at maybe 2 or 3 months operating expenses capacity, so ensure that there is adequate liquidity. Okay, so and of course we also look at another projection in terms of ensuring that our financial strategy drives business growth, in terms of projecting business scalability. Okay, projecting business scalability in the financial context, very, very, very important. All right, that important that you use driver-based models that link revenue to customer acquisition costs, and of course the churn rate. All right, so and of course we also want to ensure that the stress test is done. All right, and you also look at the scenarios, the growth scenarios, maybe under a 5%, under a 15%, under a 30%, under a 40% growth scenario. All right, so the stress test is done, all right, under those margins. Okay, so that you're trying to ensure that you create scalable business models within the context of financial projections. And of course you want to look at the variable and fixed cost breaking point, the break points of the fixed and variable cost. Okay, so that you want to ensure that the time capacity investments are actually adequate, and these results are being fed to to fund the schedules, okay, so that capital raises can happen before things go all right. Very, very important, because the corporate financial strategy must be robust enough to be able to accommodate all these projections and ensure that the ship is steady no matter the storm or no matter the economic headwinds. All right, and of course we want to talk about the data-driven feedback tool that enhance real-time decision making. Okay, data-driven feedback that enhance real-time decision making. We talk about dashboards, KPI dashboards that inculcate or integrate operational and financial KPIs. All right, I mean it's help having feedback in an accelerated fashion. Okay, you see that you can have feedback at a glance. It can help manage managerial time. Okay, so that managers can get the feedback in time, the CFOs can get the feedback in time and be able to inculcate whatever corrections, whatever thinking that is needed. Okay, so when finance teams are able to pipeline the real-time gross margins, I mean the rate of retention of the cohorts, and even the cash conversion cycle. Okay, so I mean, to the dashboard, the KPI dashboard, I mean, it helps leaders, CFOs, be able to tinker faster, okay, than their competitors. All right. So, and you have to understand that you also have the financial analysis. Okay, financial analysis of viable growth options. Very, very, very important that growth options, growth alternatives, growth opportunities are identified through financial analysis. Okay, so because capital efficient expansion itself should start with forensic financial reviews, comprehensive financial reviews. Right, so product line gross margins must be compared to accurate categories, that are due for upsell. Very, very important. Right, and you also run market sizing models to show underserved geographies, underserved communities, underserved markets, target markets. Okay, so when you run market sizing models, okay, so the underserved geographies can be easily reviewed, identified, and that can be addressed as a growth opportunity, as an expansion opportunity. Okay, so also you can also use the variance analysis to ensure to actually bring about cost redundancies. Okay, to show or to reveal cost redundancies. All right, so with the variance analysis revealing the cost redundancies, I mean those costs can then be redeployed to fund innovation, to fund R&D, and of course that will have impact on the products, quality of product and service, and impact revenues and profits for the organization. And of course, you want to be able to track competition, and of course, in terms of quality, in terms of pricing, you want to look at the gaps. Okay, you understand. So very, very important that the tracking of competition, the competitor benchmarking. Okay, to expose pricing gaps and all that. So of course, that will give opportunities for growth, for expansion, for price increase, or for quality scaling, and so on and so forth. And with that, we have come to the end of today's episode of corporate financial strategy and sustainable growth. Thanks so much for staying with me until I come up on your devices again. Keep learning, keep impacting. Thank you. God bless, and bye-bye.